everyone. Once again, I am here to discuss on yet another topic which is really interesting these days and everybody is talking about, which is inflation. So today's topic is the impact of inflation on the stock market and the possible impact of inflation on your stock portfolio. So again, getting back to the basics of the concept of inflation. So inflation is the sustained movement of price of goods and services in an economy. So hopefully in my earlier video sessions, video number 49, which is regarding the recession, and earlier videos which are session 18, 19 and 20 regarding how economy works. So these 4 videos I hope you have already gone through. So this will also really help you understand the concept of inflation to a deeper understanding. So if the inflation increases, why the central banks like RBI of India or the Fed, the Federal Reserve of US is really concerned? So we will get to all these questions, and by end of this session you will be able to answer each and every query you have regarding aspects of inflation and its relation to the stock market. So you must have heard that RBI has an inflation target which has to be below 6%, or the threshold is 6%, and for Federal Reserve the threshold of inflation is 2%. So why they have a inflationary target, or why they have a target for the figure of inflation? Why it should not be higher than that, or why it should not be lesser than that? So that's the another question. So as I told you earlier, inflation is the increase in price of goods and services. So if the price increases or even the price decreases, which is called deflation, so either of the cases there will not be any price stability. So if you have a specific inflation target, then they ensure that we have a price stability, and if you have a price stability, then it will really help for a longer term economic growth. So economic growth in the sense, there will be increase in GDP as the economy grows because the productivity increases, and if the GDP increases there is more productivity and there is more consumption as well. So if you have more productivity and more consumption, then there will be more revenue from taxes for the government. Also, if the inflation increases, then the businesses won't flourish, and also it will be difficult for people to plan their spending. Broadly, inflation can be divided into 2 types. One is demand pull inflation and the second one is cost push inflation. So in the demand pull inflation, you don't have productivity, so I would say there will not be any increase in production. So the production or the productivity will be the same, but to boost the economy, probably the central government would print money. You must have heard about quantitative easing. So that's like you inject money into the economy by printing money. So this will increase the supply of money and hence the credit in the economy, and this will lead to people buying more of products and services, I mean the goods and services, because they have excess cash or liquidity available with them. So once they do that, there will be more demand because they have money and they keep on buying things. So because of this excess liquidity and excess demand, there will be shortage of goods and services. So because of this excessive demand and lesser supply, the prices of the products will increase. So this is one way the inflation increases. Now the second thing is cost push inflation. So in this type of inflation, unlike the first type, there will be productivity or there will be increased production. So as the production increases, there will be a lot of raw materials required for those production. So more production means more raw material consumption. So as the raw materials are consumed fast because of the productivity, there will be shortage or there will be more demand for raw materials. So because of this increased demand and lesser supply of raw materials, there will be increase of the price of the raw materials. For an example, crude oil or aluminium or copper. So as the production of manufacturing firms increases, these things are the raw materials for those companies, and this will increase the cost of the raw materials. And once the cost of the raw material increases, then the manufacturing also becomes costlier because the input cost of raw material increases, so the product cost itself will increase. So this ultimately will increase the cost of production and hence the cost of end product as well. So this is second type of inflation. So in both of the cases, you must have seen, as I explained earlier, it is the increase in price of the finished goods or service. As we are investors in the stock market, I will restrict ourselves, or I will restrict the discussion to what we need to know about the inflation as far as the stock market or investments are concerned. So there are two ways by which you measure the degree of inflation. So one is the CPI inflation, which is the consumer price inflation, and the other one is WPI inflation, which is nothing but the wholesale price inflation. So consumer price inflation is related to people like us, like consumers. So how much consumption is increased quarter on quarter or year on year or whatever it is. So what is the increase in the consumption thing as far as the consumers are concerned. So wholesale price inflation, which is the second one, is on a larger scale, like that for raw materials, say the crude oil, the iron ore, or stuff like that. So these are the two inflation measurement instruments by which we can understand where the inflation is going in the economy. So as I mentioned, to arrest the inflation, because there will not be any price stability and it will not lead to economic growth, and if the economic growth is not there, there will not be any GDP increase, or there will not be any productivity, and if there is no productivity, there will not be any tax revenue for the government. So end of the day, government also needs money for running its needs. So to arrest the inflation, the central bank, so it's like RBI in India or Federal Reserve in US or etc. So they increase the interest rate to arrest the inflation. So before further getting into more about inflation, let me teach you something which is so much basic in the economy, on which these monetary policies are deployed. So I will introduce to you about the formula governing the monetarist theory. So it's a simple equation, MV equal PQ. So as you can see on my screen, M is the money supply and V is the velocity. So velocity is the number of times per year the rupee or the dollar, or in that case the currency, is being spent. So on the other side you have P and Q. So P is the price index, or I would say the price of goods and services. So this price can be either inflationary or deflationary. And finally Q. Q is the quantity of goods and services. So this is the real GDP, you can say. So on the right hand side, where there is PQ, that is together called the nominal GDP. So Q is the real GDP and P is the GDP after applying the inflation or deflation nature of the economy. So the together PQ term will give you the nominal GDP. So whatever GDP we are discussing about, or the government is mentioning, or you can see in the channels, is nothing but the nominal GDP. So we will later come back to this equation or this formula and discuss further on that. So as we discussed earlier, the interest rates are increased to arrest the inflation. Though it tries to arrest the inflation, the another impact of this higher interest rate is that it will increase the interest rate of the debt which the government or the particular government is already having. Because as I told, government requires money to run the economy or to run the country. So to run the country, they want revenue which is from mainly from tax. So also to run the economy, if the tax income or the tax revenue is not adequate, they have to take debt. So So debt is in the form of bonds. So the government releases bonds or raises bonds, and these bonds are being issued and they get back money from the investors, and you have a coupon rate for that bonds, and the government promises to give interest every year for that bond. So this is like a loan taken by the government. So again, there is a cost or the interest rate for this bond or the debt. So this interest rate or the interest rate burden of the government also will increase if the RBI raises the interest rate. Now to give you a fair idea about how much debt some countries are holding, so let us first talk about our India itself. So Indian government has a debt of around 620.7. So I would roughly tell it as 621 billion US dollar as debt, as public debt, as on date March 2022. Now talking about US public debt. So that figure is much high because US obviously is a larger country, larger economy. They have their own spending. So the US debt value is as high as 30.53 trillion US dollar. So 30.53 trillion, and note Indian debt was 620 billion. So please note the change in billion and trillion figures. So don't confuse yourself. Also to give you some comparison, in the same US, before 4 years, the debt was only 21 trillion US dollar, which is now, as I mentioned, 30.53 trillion US dollar. So again the question, why government has to take this much debt burden? Obviously the answer is government is spending more than what it is getting in. So getting in is that already I mentioned, it is the tax revenue which is an income for the government, and what he is spending on are like for social security, for health, for education, for national security, for defense related activities. So all these things are spending for the government. So they have to spend, and if the tax revenues are inadequate, they have to raise bonds and take debt and issue bonds and take the debt onto the country and run the country. Regarding bonds, already I have mentioned in my earlier session number 46. So I would strongly suggest you, after you complete this video, you go and watch those videos as well if you have not watched that. Now let us deep dive into the US debt or the US public debt holdings. So almost 25% of the debt holdings is by the federal government itself. Rest 75% is by investors. Now who all are there in the 75%? So out of the 75%, almost 40% is by the US investors itself. Like the bonds which are raised by the US is invested in by the citizens of US itself or the investors of US itself. Now another 39% out of that 75% is investment from foreign. So those are the foreign investors. So again in that, if you dissect it, the main holder of funds or the debt is by Japan. After that comes China, and after that it's UK. And there are other investors, foreign investors as well, including India. So we have our small stake in US economy as far as the bond holdings are, as far as the debt holdings are concerned, in the form of bond funds, in the form of bonds. Again, out of the 75, some amount, some percentage is held by the Federal Reserve also, which is Central Bank of US. So you will be noting that almost, as I mentioned, 39 to 40% of the debt is held by foreign nations like Japan, China, UK, etc. So these people want the dollar to go high. So how the dollar will be going high, I will be soon explaining. So they want the dollar to go high, the US dollar. So as the US dollar goes high, the imports from these nations like Japan, UK, China, etc. to US becomes cheaper, because dollar increases in value means it has more buying power. So with a cheaper currency of China, Japan and UK compared to US, the US imports become cheaper and they import more. So this again increases the exports from these countries. So they increase the country's GDP. So this is another agenda of US, another agenda of they want the US being going high. I mean the USD being going high. Now your doubt would be how the US dollar would go high. Now your doubt would be how this US dollar would go high. Now already you are aware that Indian rupee is at a all-time low compared to US dollar. So it has just recently touched 80 rupees. Now it's at something around 79.7 or 8 or something. So hardly it's 80 rupees. So as years passed by, we have seen that the dollar value has increased and now it is at all-time high of 80 rupees. Now also if you see euro, the European countries euro also has fallen very much compared to US dollar. So now the euro to dollar ratio has fallen below 1. So that again shows that dollar is gaining strength over euro as well. Now dollar is at its 20 years high from early 2000s. Also you must have heard that inflation in US has hit all-time high. Like in the past 40 years, it is the highest inflation rate ever in US. So you must see the importance or how critical it has become in the economy of US. As the US inflation has hit 40 years high and also the interest rates has been increasing every quarter. So even every month I would say. So based on this increased interest rate, the common sentiment that the Federal Reserve, which is the central bank of US, won't be able to maintain the inflation or will not be able to arrest the inflation, and that they will have to keep on increasing the interest rates. So based on this sentiment, as the interest rates have increased also, so this interest rate increase has led to higher yield from US Treasury bonds. So US Treasury bond is a safer, or I would say a risk-free investing instrument. So the investors lose hope in stock market, which are like riskier assets to invest in, unlike a bond fund wherein it's all government based good rating bonds. So they take out the money from stock market and invest in bonds, US Treasury bonds. So the investors worldwide, including the foreign investors, have faith in the US Treasury bonds, which are safer, and they get out of the stock market and try to invest in the US Treasury bonds. So again, to invest in US Treasury bonds, the investment will be again in the form of US dollar. So you have to have a US dollar to invest in the US Treasury bonds. So again, the demand for the US dollar increases. So as the demand for US dollar increases, again the game of demand supply. So if the demand increases, the US dollar value also appreciates, which is what we are seeing in the market now. As I explained earlier, Japan, China, UK all wants the US dollar to appreciate. Their exports to US becomes higher because of the higher buying power of US dollar. But the issue with the US companies, US based companies, especially those who exports from US to other countries, is that as the dollar value appreciates, the buying power of the other countries reduces, because the products of the US becomes costlier as the dollar value appreciates. So it will have a direct impact on the exports from the US. So this again will impact the GDP of the US. So that is why US government, even Federal Reserve or the US nation also doesn't want the US dollar to increase beyond a level. Yes, this is a good thing for the US citizens, that if the dollar value increases, US citizens can buy more goods which are imported. Again, if they want to go to some countries like India, China in that case also, so they have a higher value US dollar with them and they can spend more because the respective nation's currency has depreciated in comparison to US dollar. So their spending power increases as far as the US citizens are concerned. But mainly we have to be concerned, or the central bank has to be concerned more about the productivity or the large companies of US, wherein the exports become costlier and it will reduce the exports and hence bring down the GDP. So if that business gets slump, the revenue of the government from the taxes imposed on these businesses will reduce because their productivity has reduced, their demand has reduced. So this will again impact the debt burden of the government. So you need to have the central bank or the government needs to have a fine balance between all these things. Again, another thing which I want to highlight here is that US is not such a highly populated country, unlike China or India. So in China, if you see, the economics are different. So their GDP, out of their GDP, almost 38 to 40% of their GDP is only through internal consumption, because they produce and they spend inside China itself. So they are the largest populated country in the world. So they have this much population that they consume themselves and they contribute to the GDP at around 40% only through internal consumption. But in US, the country's population is low, so their main revenue is through exports only. The US dollar appreciation is not actually good for strong economic rebound in US. Now getting back to the inflation. So inflation increases, the interest rates are increased by the central banks to arrest the inflation, or at least their effort to reduce the inflation. You must be seeing Federal Reserve is increasing the interest rate every month. So they have again increased to 75 basis points this time. So this interest rate increase, by this interest rate increase, they try to arrest the inflation. The inflation has touched 9.1% in US now. So their inflationary target is 2%. So to bring down 9.1 to 2%, it's a large task. So only by increasing the interest rate every month won't help. So that's a different subject as in. So here, as the inflation increases, the interest rate increases, the debt burden of the government increases. So the question is that now, how to pay off the debt? So will the government go bankrupt? So the funny thing here is that actually the government will not go bankrupt, because they have the power to print money. So if the debt burden increases, they print money and they can service the debt. But really what they should be doing is that they should increase the productivity. So increasing the productivity, as I mentioned earlier, will increase the revenue, the tax revenue, and will really help government to service their debt. It's like they cannot just keep on printing the money, because this will again lead to high levels of inflation, and higher levels of inflation again leads to unsustainable price stability, and again the revenue goes for a toss. Means the economy goes for a toss, and hence the revenue also is reduced, and this will not help the economy to get revived. So again the threats of inflation things, everything comes in. What they have to do is to increase the real productivity. Now again, let's get back to our equation of MB equal PQ. So in this PQ, we have already mentioned that Q is the real GDP and P is the price of the goods and services, which is either inflationary in nature or deflationary. So how they increase the PQ or the nominal GDP is through propaganda. So they lie to you by the propaganda and make you spend more than what you really do right now. So more spending means more production, more productivity by companies. So more productivity means more revenue. So more revenue means more tax collection by the government, and hence this tax collection, increased tax collection, can be used by the government to service the debt. So this is what Federal Reserve or the central banks of India or wherever it is trying to do to arrest the inflation and bring down the high interest rate or things like that. So to have a balance between all these things. So this propaganda is mainly by two ways. So this I am very specific about the US economy. So one is negative interest rates. So negative interest rates means if you are a borrower, it is the best time to borrow because the interest rates have gone very low. So the cost of borrowing also reduces. So you can borrow at a cheaper rate and still meet your needs. So the borrower end of the day has to spend or pay back very less to the banker, which is the lender. So that is how the central bank increases the consumption theme in the economy so that the economy revives. So the second way by which they try to revive the economy is by delivering inflationary shocks. Say for an example, Federal Reserve or the Fed estimates or promises that the inflation will be within 2%, and later once the actual figure comes in, the inflation would be 3%. So this is like the people had thought that the inflation will be 2%, and now in actual it has become 3%, means there will be in a panic. They will be in a panic and they'll think that now the inflation is out of control and it is going to be very much out of control going forward, and they will go out and spend and try to buy things, or they will try to buy goods and services as soon as possible before the inflations are much higher or out of control. So this is how, by delivering the inflationary shocks, the government try to increase the spending in the economy for the consumers. So both of this spending will increase the production in the economy, and this will increase the turnover or the GDP of the country. And that is how the tax revenue is being ensured by the government. Always note that a deflation, which is the reduction in the price of any products, cannot be taxed by the government. Only if there is an increase in the price of a product and people spend more, then only they can tax it. So if at all there is a deflation, and if your salary or everything which is the same year on year also, then you as an individual will have a gain, but government will not get revenue out of this because there will not be any increase in tax, so they will not prefer this. So this is another dark side of it. So concluding, the inflation is a very important macroeconomic factor to be considered while you invest in the stock market. So inflation is, if inflation is very high, it is not good for the economy, and if it is very low, it is again not good for the economy because it reduces the spending and it reduces the GDP and revenue for the government. End of the day, it will again lead to economic slowdown. So you need to have a fine balance as far as the inflation is concerned. It has to be backed by a consumption theme, and also equally productivity should be there. So this shows that inflation is important in the economy, it is required, but not beyond some limits. So these days, as you hear, inflation is high, the interest rates are increasing, the recession is coming. So hope this session on inflation really helped you understand all the concepts, and added to this my earlier videos on recession and also how economy works and regarding the bonds. So if you add up all these videos and if you have your own analysis, you will be very clear on the entire aspects of what is going on currently in the economy. Hope this session helped you. If you like the content, please do like it and do share. Happy investing.